This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty with the Market Guys, and I'd like to welcome everyone to tonight's open house Q&A session. I want to warn you, I'm loaded with birthday cake after coming from my granddaughter's third birthday party at their house. We have two little granddaughters, the oldest of which is 3 years old, and that was a lot of fun. One good thing about having birthday parties for kids under 5 is I can get home early and I don't have to worry about staying out late. I was still able to get back here and do the webinar for you. So that's all good. You know, this is already started off to be a very interesting week as we look at a one-year chart of the diamonds, which is the Dow Jones Industrial Average ETF. You could see that my lines are still on the chart from last week's market report. And last Friday was right here on this green candle. And I spoke about the long shadow under the candle from Friday's trading day. And although we closed lower today, you can see that once again, we have another long shadow. When you see long shadows under the candle, it doesn't really matter what color the candle is. The fact that there is a long shadow under the candle tells us that on both of these trading days, the sellers tried to push it down to new lows, but were unable to maintain those price levels at the lows. So the long shadow is a result of the buyers coming back and fighting off the sellers to get it off the lows. That's number one. Number two, if you've been following along with the Market Guys long enough, you'll know that on almost every stock that I analyze, I always compare the price action to the volume. So here's going to be a test question or a quiz question for those who have been following along. If you see a stock going down like we have in the past 3 days with lower highs and lower lows each one of those 3 days, and then you see the volume drop while the price is dropping, what does that tell us? Who wants to be the first one to answer that? I know there's a little bit of a delay in the type. Okay, Nathan is first to come in with an answer of bullish. That is correct. Dave put it another way. He said the sellers are losing momentum, which again, think about it. If the sellers are losing momentum, that is a bullish sign because it tells us that the sellers are slowing. Stuart came right back, very similar answer. The sellers are weakening. Yes, absolutely. Now, you'll also notice that today, the moving average here, by the way, if you look to the right of my chart for the diamonds, the blue price list right there is 214.66. Look all the way to the right. That is the value of the 20 period moving average as of the close today. So 214.80, 214.66. Today's low was 214.68. So today's low came within 2 pennies of the moving average on lower volume. And so there, the moving average is acting as a support level. Now here's quiz question number 2. When you see a stock gapping down, so here on Friday we gap down, you see this little price gap right here. What are some of the rules for gaps? Can anyone tell me if the gap is above the market, what does that indicate for us as traders? Okay, Phil came back and said the gap is not filled. That's correct. Let's see. Amalia says fill 80% of the time. That is correct. That's one of the gap rules, is that when you have a gap that's open above the market, there's an 80% chance that the gap will fill. Ken said the same thing. Herschel said the same exact thing. Stuart, Greg, Nathan again, and Dave, you're all right. There's a very high chance that the gap will fill and the price will start to go up. All right, so you're all reading this the same way as I am. The only thing I'm doing is more or less, maybe it's not so obvious, so I can't say I'm stating the obvious, but as you get to learn the technical signals and see how consistent they are, like gaps and support and long shadows below a candle, then when you start looking at the charts on your own, hopefully all these things that I've been repeating month after month in these open house sessions, hopefully those things that I repeat, they become ingrained in your mind, so that when you're looking at a stock, whether it be for the first time or you're tracking a stock multiple times during the month, you're going to be mindful of these signals as we see them. So when I saw that long shadow and I saw the moving average here and I saw the gap above the market, that is why I drew my line here in the forecast that I thought we would start to move up to fill the gap and maybe test this resistance. Now, why would I pull back from that resistance? There's a reason for that too, although my reasoning behind drawing a rally, a short-term rally, and then a pullback from resistance is not so much a signal that I saw in the market, but more so what I'm reading in some of the financial reports. Let me see if I can find that for you. I highlighted, let me see if I can go to where I saw, it was on one of the financial pages. Okay, marketwatch.com. You see right here, that's one of the news sources that I track. MarketWatch came out with an article basically saying the Fed to stick to plans for rate hike, balance sheet sell-off this year. Now, again, that's an abbreviated headline, but basically what this is telling us is that the Fed is most likely going to stick to a plan of tightening or raising rates. And when you see that happening, and the Fed is talking about hiking rates, that is generally bearish for the overall market. So the short-term signal here on the chart on rally, again, short-term rally, but my mindset is still stuck on lower prices for the overall markets. And it's not just economic news that I follow, and it's not just corporate news with regard to earnings and such. I also follow very much, as we all should, I follow the political news. And I think we can all agree that the political landscape right now is extremely volatile. And when you put that political volatility into the mix and try to more or less read how the investor community is going to digest unsettling or volatile political news, you have to admit that investors do not like political volatility. Look at Venezuela. Look what's happening there. Look what happened, several years ago when Spain and some of the other BRICS countries started to turn down economically. The markets, the investors, I should say, which represent the general markets, do not like volatility. So when I look at the diamonds and then I go and I switch this chart to a monthly chart, again, it's very, very obvious to me that, again, and I think I've said this in the past three open houses, this is the second longest bull market that we've had in American history. And if you look at the price, remember the price volume analysis, if you look at the price over, this is 20 years now, from 2008, 2009, you can see even further into 2010, 11, 12 and such, you can see that the volume highs, look at that. Isn't that incredible? The high spikes in volume are lessening. In other words, over the last 7 years, almost 7.5 years now, the volume is consistently going lower. That is very, very different than what we saw from 2004 up until 2008, where we saw the volume highs increasing up until the top of that particular bull market, and then eventually the sell-off into 2008. And you know, a lot of people criticize me, and I am very open to criticism. I'm okay with that because I think questions and debate are very healthy. A lot of people come to me and say, AJ, you've been predicting a downturn in the market now for a couple of years now. What's the deal? And I tell them straight up, and for those of you who are subscribers to the Oracles, you'll know that my long-term perspective or opinion of the market is bearish, but we are actually still playing long positions in our individual trade alerts. We're still playing stocks from the long side. And you might think, well, isn't that a conflict with your long-term opinion of the market? Well, it could be if I were not defensive. In other words, every long position that we have is built on a short-term signal that we're seeing, just like we saw on the short-term chart of the Dow here. Short term, I think the market could go up, and as swing traders, we're not looking to hold forever and ever. We're looking to get in, take a profit, move out, get to cash, and start it all over again. But my point in telling you and looking at the long-term charts of the market and how the volume is drying up is that on a moment's notice, in a very, very swift decision that we might have to make, if the markets start turning lower and we see big breakdowns of moving averages and support and increase in volume on the way down, we as traders really need to be able to turn on a dime and actually reverse our positions 180 degrees. I think it's only smart to talk about the possibility of an extreme correction. And I don't think that right there is even based on opinion. It's based on fact that if you study history, every single major bull market we've had eventually broke. And when that uptrend broke in the bull market, it broke in a big way. And we had severe downturns in the market that were very, very swift. And unfortunately for investors that were in the buy and hold mentality, they didn't know what to do because their brokers are telling them, oh, calm down. We've seen this storm before and we will be okay. And blah, blah, blah. They don't know how to reverse your position. So they're going to just try to calm you down so you don't take your money out of your brokerage account and move on. They want to hold on to your money. That's what brokerage companies and brokerage firms and banks do. They want to retain you as a customer, so they're going to do what they can to calm you down. Listen, my job is not to calm you down. My job is to educate you and open your eyes to the world of opportunities that we have on the downside. There was I was looking before we started. I was looking at stock Amazon. And the reason I was looking at this is because this stock trades very technically. If you remember, it wasn't too long ago I drew these fan lines. These are all the lines that I drew and stayed in place. I said, once this fan line breaks, what's going to happen? It's most likely going to drop to the previous fan line. It did that here, then dropped through that, and it dropped very close to this fan line. Now, look at Amazon. Amazon is going up in another extreme way. There's good news out on Amazon, so that's why investors are getting in. But one of the other headlines that I read, let's see if I can find this here. One of the other headlines was that Amazon, where is it? It was on here somewhere. Oh, Amazon, I know I just saw it. Hold on. Amazon was on track to be, oh, here, right here. Amazon set to be world's most valuable company. Now, how do you get in the way of that? We all know Amazon is taking over and competing with Walmart. They're actually starting to crush Walmart's retail numbers because they're so quick on delivery. They have very little overhead. They don't inventory a whole lot in big warehouses and cost to carry of large outlets. Amazon is very lean, very quick to turn and adapt, And here's an article that proves it. And this came out of CNBC. So I was looking at that news. I was looking at the stock, and I'm thinking, okay, if I were an investor, would I feel comfortable buying Amazon at $1,038.95? Well, I might feel comfortable if I was only going on news and maybe some recommendations. But when I look at these technicals, short term, I think Amazon could absolutely pull back. It could. This kind of stock right here can easily drop $50 a share, and the average person is not going to be able to get in on a stock like this, because if they have 50,000 shares, $50,000 in their account, they maybe could buy 48 shares of the stock. And what is that going to do? Can't make them a whole bunch of money if you're only buying 48 shares. So this is being controlled by the institutions and the option traders. The option traders can absolutely trade a stock like this and not have to spend a whole lot of money. Now, I don't want to get off on a tangent. I was just really going over some of the signals I'm seeing in the diamonds and some of the others. Now, in the weekly market report that I put out, I also mentioned that the Russell 2000 does not always move in sync with the diamonds, and it's true. The Dow Jones Industrial Average represents 30 stocks. The Russell 2000 represents 2,000 stocks. Now, this last week, the Russell 2000 broke out of this resistance, but I left my lines in place because I think that the Russell 2000 can actually pull back. Why? Look at this. Last Friday, we see a bearish engulfing pattern, and we see a long shadow above the market. You see, so this is how I'm reading the signals. And if the Russell 2000 closes back below what is now a role reversal support, if we close down below support, then chances are the downturn in the Russell 2000 is going to accelerate. You see, so that's how we're reading that. And then, of course, the Qs, which represents the NASDAQ market, I still think this one is a little overbought. There's gaps below the market here. There's another gap below the market way down here. I'm not going to put too many lines on these charts because I save the forecast lines week after week to prove and show the evidence to the people that follow that. I don't want to move those lines at all because I want to maintain those so we can see how the forecast played out at the end of this week. Okay, now Mike had a question. What about the previous gap on 712? Now, Mike, which stock were you talking about on that? Which index? Was that diamonds? Let's see. I'll go back. DIA. I think. Let me see. And Mike, if you could put that back in, I'll be able to see that. Let's see. DIA. I'm pretty sure that's when I was looking. 712. Is that here? Back here? Okay. I think that's what you're talking about. Yeah, there still is an open gap down here. Absolutely. That's on 712. And if I drew a horizontal line, eventually, like the gap rule that I talk about all the time, this price action from today is actually stuck between two gaps. Open gap above the market and an open gap below the market. Hence, another reason why I think eventually this gap will fill, quick upturn, then a pullback. I really believe that gap is going to fill, and I'll even go on a recorded line right now, and I'll tell you I'll stake my reputation on the fact that gap will fill. On the diamonds and on almost all the other indices, the gaps do not remain open. It's not like a stock. You're dealing with a group of stocks, and so when you have an index and even a few indices in line gapping up, all the more reason, or the greater the chance that the gaps below the market will fill. So again, I'm a very, very cautious buyer on any kind of new position. But like I said before, on a moment's notice, we all should be ready to reverse our positions 180 degrees and get ready for a downturn. Listen, folks, don't get stressed over that. I think it's much, much better to expect it, and so that you're ready to pounce on a down market, because when the markets go down, they go down much more quickly than they rally, because you got the fund managers, you got money managers, you got banks, brokerage, insurance companies. They're all dumping their portfolios because they have to. Unlike you, so you can make a decision to hold on all you want, even though it might cost you money. That's your decision. But with a fund nowadays, a lot of the funds, if you read into the prospectus of those funds, they have a stipulation where if the stock closes below the 200 period moving average, they are required by prospectus to sell out in order to limit the risk. Make sure you read it. If you buy any kind of a mutual fund or even some of these hedge funds, go to the website and open the prospectus. There's a report that put out by the companies or the managers that manage those funds, and they have to really write it out in the prospectus of how they're going to manage risk. And if it closes below the 200 period moving average, many fund managers are required, again, by prospectus, to sell out. And that's why the 200 period moving average is so powerful when we're starting to turn lower. I don't have the 200 period moving average on this chart because I'm only tracking the 20 period moving average, but you definitely want to pay attention to that if we start breaking down below the 200 period moving average, for sure. Okay, let's see. Question comes from John. What is charging the markets? What happened to sell in May and go away? Right. Well, let me tell you what's happened. It's the Trump effect. That's what it is. And the markets are actually counting on Donald Trump fulfilling his campaign promise to put a tax plan in place that will reduce taxes across the board. Now, guess what? Donald Trump is not going to have an easy time of that. He's being fought tooth and nail by whatever party you belong to. It doesn't matter, Democrat or Republican. There's many Republicans that are fighting Donald Trump. And now Jeff Sessions is in the mix, and with the Attorney General, recusing himself with this special prosecutor. It's crazy. I followed politics for many years. I've never seen it like this. So the markets are betting on Donald Trump as though he's never going to suffer a defeat, and he's trying. But imagine, here's a very powerful question. Here's a very powerful question. What if Donald Trump gets a tax plan, but it's 5 percentages short of what he promised? What do you think the markets will do then? What do you think if he gets a tax plan? I'm being optimistic that he will get a tax plan passed, but what if it's 1% shy of what Donald Trump promised? What do you think the markets are going to do? Well, I'll tell you what the markets are going to do. The markets will go into a sell-off, even if he misses by 1 percentage point. That's what will happen. It's kind of like if who's coming out with earnings tomorrow after close? CMG. All right. If CMG misses their earnings by 1 penny, a lot of times the market will sell off because, investors expected better. It's all built. This is all investor expectation built into this market. That's what's really charging it. And I will tell you, I truly believe this is one of the biggest bubbles we've had, because we had a bull market going right through both terms of Obama in the White House. It kept going up. And I remember the day, it was in 2009. It was the beginning of 2009. And President Obama at the time said, don't bet against the stock market here. I don't know if any of you remember that. He said, don't bet against the stock market. I'm thinking, that's highly unusual that a president would make a comment about the stock market to American citizens. That's normally not the way it goes. You might have the Fed chairman or the Fed chairwoman, Janet Yellen, saying something like that. Even Greenspan talked about the stock market with irrational exuberance, but never do you see a president making a comment on the stock market. And I remember Barack Obama saying that, and this bull market is continuing through the Trump presidency. I think that's very dangerous because we have no pullback, correction, or an end to this bubble. And again, I look at that as an opportunity. I think that many people who are getting into the market for the first time really need to learn risk management before they pull the trigger and get into a stock. But, you know, listen, they're all on their own. I'm doing my very best to try to get people to understand the technical signals. All right, now, I think that's enough market review and political talk. Let me just say this. Let me just do a quick how many people we have on here? Okay, we have a lot of people on this call. Some I would say most are members of our Option Oracle and Equity Oracle. There are some guests. We opened up July to some guests who want to just kind of sample the market, guys. Let me just tell you something that's extremely important about technical analysis. The more people who follow the signals, the more accurate the signals become. Let me say this again. The more people who follow the signals, the more accurate the signals become. Now, let me use a parallel analogy to the charts. And let me say it this way. If you have an analyst, I don't care if the analyst is from XYZ company, the more people who follow the analyst, the more accurate the analyst's forecasts are, because now that analyst carries a larger audience. There is no voodoo magic tea leaves about this. If we see a long shadow and we see a gap above the market and many millions of people react to that signal versus many tens of thousands of people, then the millions of people are going to drive that market to the exit points or to those target prices more so than tens of thousands of people. Does that make sense? Now, years ago, and I'm talking 30 years ago, before I even had a computer to track the charts, I had to do it by hand. And back then, when we were doing by hand, believe me, there weren't even tens of thousands of people following us when we were doing it manually. Because back then, in the early 80s, technical analysis was really like, it was like tea leaves and forecasting. It was like crazy witchcraft, believe it or not. The fundamentalists, the ones who did all the research, the Merrill Lynch's, the Dean Witters at the time. I remember an analyst from Dean Witter. He was a technical analyst for Dean Witter. He was like the black sheep of the family, because all the fundamentalists looked at Mark Kaplan, was his name, looked at him as, there's that guy with the crazy charts in his pocket, you know? So not many people followed the signals. But as charts became more recognized and more people learned and became comfortable with the signals, the more accurate the signals became. And now guess what? The institutions are now following the charts more than they are their own fundamental research. Isn't that interesting? So I basically am inviting all of you to be an ambassador to technical analysis. Teach people what you know. I'm not telling you fake it until you make it, or try to teach people things that you don't know about, but teach people what is support, what is resistance, what is a gap. A lot of you already know those basic things. What does it mean when volume drops? If a stock is dropping and the volume is increasing, should I be buying it then? No. Tell people about that. Wait for the volume to drop. It's okay to buy a stock when it's on a downtick or reaching support, only when the volume is dropping. Don't buy it when the volume is increasing, because you're going to get slammed. It's like stepping in front of a freight train. So be an ambassador for people who are learning. Teach basic things. Hand someone a book. Invite them to read a book. Give it as a gift, a birthday present, whatever. And teach more people about this, because it's only going to benefit everyone who looks at the charts as a tool, not just for forecasting now, but also for managing risk. You know, if I'm thinking about buying into the diamonds, and then all of a sudden it breaks down below support and it starts going lower on higher volume, hey, I have to do something. I have to pull the trigger. I got to get out. So that's it. Okay, now Ron, look at it, Larry, Ron, and Michelle. You got ahead of me there. Okay, here we go. I'm going to start with Larry. And by the way, folks, you could start typing in stock symbols. Please let me know what your intention is, or what your idea is on the stock, so I know, where to guide you with this, because I want to read the signals for you. Right now, Larry says HTZ is showing a cup and handle. Let's see, HTZ. Take a look at that for Larry. This is Hertz. Oh yeah, I would say. Let me just read Larry's whole question here. HTZ is showing a cup and handle. I want to buy September or October 15 calls. Your thoughts? Number one. Now people who just equity trades may not get this, but I'm going to answer Larry's question. Larry, I shy away from buying front month options. And I think September is too close to expiration. I think October is a little bit too close. That's number one. Number two, I hardly ever, in fact, I can't remember the last time I ever bought an out of the money call or even an at the money call. That's very close to being at the money. Now, let me tell you, a cup and handle, I see, but I don't see a full cup and handle. I only see the cup. And again, for those of you who are brand new to technical analysis, go out there and go on Google Images, go to your search engine, click on Google Images, and type in cup and handle chart pattern. Just type in cup and handle. This would be the cup, if you can see my cursor here. This is the cup. So the brim of the cup would be from end to end. So here would be resistance. Now, what happens in a cup and handle, you could say that the cup is already formed, but the handle is starting to form. This stock could still pull back a little bit before going higher. And even then, if it did this area right here would be the candle. The buy point wouldn't be until the stock actually breaks out over the brim or the rim of the cup. So your buy signal still is not going to be until it breaks out over 18. So you could watch it, but I wouldn't anticipate that, because this stock could very well pull back to this moving average and drop $2.69, $1.69 rather. What is that, $2? No, that's $2.69. It could still drop because the rubber band is being stretched right here. The stock does not like to stay this far above or below the moving average. So this stock looks like it's on its way back towards that moving average. So be really, really careful with that. Okay. Now Ron types in MFA. Let's type that in for Ron. And let me see, Ron's idea is he bought it at $7.92. So you're up right now, Ron, by, was it 92? So you're up 63 cents already on a $7 stock. That's not too bad. Now, Ron has a stop at 814, which is down here. Ron, I think that stop is too low. I think that if you bought it at 792, I would put my stop maybe somewhere below these lows here, right below 840, or I might put it right below the 20-period moving average, below 8.5. And I know you're only 5 cents away from that, but the reason I say that is because if you look at this moving average, it's gone from an upward direction to a sideways pattern, and you got a double top up here forming. You see that? With a bearish engulfing pattern right at the second top. That's number one. Number two, my eye immediately goes down to the volume, and I can see that as the stock is going up, the volume is dropping. You see this? And today's volume is just a fraction of what it was from Friday. So I would be really careful of that. If it were my position, I would actually take a profit. I would be taking the profit and then waiting for a bounce off of the next key support level. That's what I would do. It doesn't give me enough evidence to hold on and risk the profit that is currently built in. You have unrealized profit. That's number one. Number two, Ron, this is a great question that you could always keep on the side for yourself. Whenever you're in doubt about what to do with an existing position, especially one that has a profit built into it, you have to look at the chart as though you did not have a position at all. And you say to yourself, if I didn't have a position and I have buying power in my account, would I be buying this stock today? Would I be taking a new position today? Well, today I absolutely wouldn't, because it's a red candle on lower volume. Maybe on Wednesday I would have, because that's a bullish engulfing pattern there. See, bullish engulfing pattern, yeah, you could add more. The doji gives me pause because that's a sign of indecision. A spinning top is giving me a little concern. And this red candle, you see, you got all these three little candles in a row. With that red candle being there, I'm thinking, you know what? I'm gonna get out, take my profit, and then if it bounces off of this support, if it comes back and bounces off of the 20-period moving average with another buy signal, then I would do that. So hopefully that'll help you there. Okay. Oh, wow. The stock symbols are stacking up. Michelle, welcome back. It's good to have you. Michelle says, thinking about buying UNG. The January $5 calls. Let's take a look at UNG. Let's take a look at that. That's United States Gas. Well, you know, Michelle, I like this so far. I mean, again, my eye looks at that volume, and like we said before, when the price is going down and the volume is going down, that tells us the sellers are losing momentum. So that's number one, the sellers are slowing. Number two, the stock has stretched below the moving average. So the rubber band is being stretched. That's signal number two. Signal number three, you have 5 red candles in a row. That's a stale red light. That's bullish. That's 3 signals. You got a gap above the market right around 730. That's good, right? So you have 4 pretty positive signals. And so before I give you the idea of behind the $5 calls, let's take a look at the weekly chart. And you can see that UNG is also not far below this 3-year low, which is right around $6. So that's promising. I would even categorize that as a 5th signal to go long. So you got everything going. Now let's switch to the option idea that you have. The January 2018 might be a little bit too close. And for a $5 call, you might consider buying the 2019s if they have it. I don't even know if they do. Hold on. I'm going to move this screen out of the way. Do they have 2019 leaps? Let's see. Why is my screen? Okay, they do have 2019s. The $5 calls, wow, that's pretty cheap. I like that idea. And the reason I would go with 2019, again, equity traders, forgive me as I talk options with Michelle, the $5 calls already have $1.47 built into intrinsic value. So there's $1.47 already. So if you spend, let's say you buy these for $1.87, you're only spending 40 cents over intrinsic value to hold a $5 position. I think the 2019s are better, and you won't suffer any time decay because that's so far out. So if you buy that at 187 and the stock goes up here to $7, you'll have a pretty strong percentage return on that. And even then, I would just watch it on the way up because you got a gap above the market. I would probably get out of that call position if it hits 730. So if you decide to take that managed risk, don't overbuy the position, only spend what you can lose and protect it on the way down. I would say a get out point would be a drop below that support level right here. So that's a very tight stop, but I wouldn't hold on below that low right there. Okay, Philip, SLV. Now I got to tell you, Philip, I do have a long position, a pretty significant long position. SLV is up about $1 in the past week and a half. And I got to tell you, even owning the SLV position, I really hate it when it gets close to filling gaps on the upside. I was looking at this before we started, and this low right here from June 30th, the low there is $15.70. So when the stock, today's high, was $15.67, so it's 3 cents away from filling that gap. And what I have to tell you about that is I would wait I would wait for the SLV to pull back before getting long. And here's what I think could happen. Even though I'm long, and I don't want it to go down, but I think it will go down short term, is that when this gap fills, again, it could be tomorrow, if it could go up 3 cents, fill the gap, 80% of the time after a gap fills, it drops. So I think silver could do this. That's what I think silver is going to look like, because there's still a very, I think there's a minor gap right here, very like a penny gap. So I still think silver could pull back a little bit after this nice long stretch it had to the upside. Pull back, there'll be some short-term profit taking, but I think that that 20-period moving average could very well act as a support level for the stock as it bounces. So I don't see any harm in waiting just a little bit for the pullback, getting long, and then putting your stop somewhere down below 1440. That would be the best bet, because 1440 right around there, maybe 1430, you could put a stop below that. Hopefully that helped you, and I'm going to get on to the next one, which is Roberta is looking at AT&T. Roberta does not have a position, but interested in my technical analysis of AT&T. Now, let me just tell you a little bit about AT&T. Not only did I drop their service because they get very poor coverage here in Florida, that's my location. I can't really blame that on AT&T. They're a very good company. But AT&T is going to have a challenge, maybe with Netflix. I'll talk a little bit about that. And actually, they're also going to have a problem with Amazon Prime. Amazon is actually moving into the entertainment industry. Netflix is already there, but I think Netflix and AT&T, Netflix and Amazon could be the biggest threat to cable companies or companies that provide cable television. And AT&T is going to have to really watch that, because they're going to take a big hit in loss of subscribers on the cable side if they're not careful. And I think we're seeing a lot more other commercials competing with AT&T. So there's a lot of competition out there. That's on the fundamental side. Now let's take a look at AT&T on the technical side. You can see obviously that there's a double bottom right here. You see this? There's a double bottom. Last week we had a hammer pattern right there. Let's take a step back and look at the weekly chart. This double bottom, if I was extended to the left right here, you'll see that the double bottom actually was a former role reversal. See, former resistant, broken, turns to support here and here. So AT&T looks like a very, very good long position if it bounces. That's the big thing, if it bounces. If you look at the weekly chart, can anyone tell me what this 2-day pattern is right here? Can anyone see this red candle and this green body candle? Anyone tell me what that is? Who wants to tell me? Let's see. I'm waiting for an answer to come up. I know someone's going to get the right answer. I can feel it. Okay, Greg is right. It's a bearish engulfing pattern on the weekly chart. So if AT&T does not close with a higher low this week, then all bets are off for any long positions. Okay, Roberta, be careful of that. The weekly candle chart trumps the daily, no pun intended here, political pun. But if you look, bearish engulfing patterns on the weekly chart have resulted in much lower prices. You can see here is the bearish engulfing pattern. It dropped. Here is a bearish engulfing pattern. It dropped. When you have a bearish engulfing pattern on a support line, that's buyer beware. Be really, really careful. So if you do decide to buy AT&T, you're going to have to put your stop probably right below last week's low, which would be a stop somewhere below 35.81. Take good notes on that. And I would still wait for the significant bounce off of the daily support level right here. Because, hey, look at that. I didn't even notice this until now. This is very close to a bearish engulfing pattern today as well. Let's see. It opened at, where did it open at? Okay, at 36.51. Where was the close? The close from last week was 36.51. Yes, this is a bearish engulfing pattern today. It's probably going to go a little bit lower. Hopefully by the end of the week, it'll be a little bit higher, and then I would buy it on that bounce. So if it looks like that, go right ahead and put your stop. Okay, D. McLean, NTNX. Let's take a look at this NTNX. I haven't heard about this stock before. Let's take a look. First of all, I don't like the fact that there's a gap below the market. So if you're going to own it, this is one of those times where the stock is caught between two gaps. So this would be your gap fill point. I would expect this stock to pull back, possibly bounce at that fill point. So I would be more of a buyer down here, right around 20.5, rather than trying to buy it up here. Because remember, 80% of the time gaps fill. So there's an 8% chance that the stock is going to drop. So if you buy it at 23.36, you're risking roughly $3 on a $23 stock. So I think it's better to wait. And then also watch the general markets, because a stock like NTNX, this one could have the domino effect. If the overall markets start pulling back, this could be one of those stocks that'll fall in price just out of sympathy for the rest of the market moving lower. So you got to be careful of that. Yeah, this one doesn't feel right as a good buy candidate just yet, but that's not to say sometime in the near future it could be a buy. So I would put it on my watch list, but it doesn't feel right for a buy at this particular point. Okay, Mike has submitted. Wow, I got to speed it up. We only got 15 minutes left. This is unbelievable. Keep me very busy. All right, SPWH, Sportsman's Warehouse Holdings. Obviously, we see a stretch of red candles here. Okay, Mike. You say worth hanging on. I don't know. Where do you own this one? Do you own it at 10? Do you own it at 8? Do you own it at 7? I do not like it when stocks drop below 5. I've mentioned this before, but I think it's worth repeating that when a cheap stock like this drops below $5, the brokerage firms up the ante, and what I mean by that is that they shift the margin requirement. When a stock drops below $5, anyone holding the stock on margin at that point gets a margin call. In other words, the broker calls them up and says, listen, either you got to put more money in to finance this losing position, or you have to sell the position. And most people choose the latter. They would much rather sell the position when they get the margin call than to bring good money in to finance a bad position. That's number one. So if you hold it, you got to be really careful. I mean, I would absolutely say that if this thing drops below this support level right here, below $4, I would say below $4, that's a kiss of death for this one, because that thing could be on a very long road to recovery, because at that point you're going to have everyone out of it on a margin call. That's number one. Number two, we look at the weekly chart. My guess is that, ouch, yeah, that hurts. This volume doesn't look like it's really dropping all that much. You can't count today's volume in with this because it's only Monday, but it looks like the volume on the red candles is still maintaining. It's not dropping. If by the end of this week we have lower volume, that would actually be a bullish sign that you have this long stretch of red now possibly weakening. But again, this is another one that you got to be really, really careful with. I hate to tell you to hang on and then have it drop below $4. Listen, one thing you can do, and this goes for everyone. If you're holding on to position, it's hurting you. You're trying to decide, do I get out? Do I hold it? What do I do? You have to look at it and say, if I did not have a position, would I be buying this stock right now? That's a great question. If the answer is no, I wouldn't be buying it right now, then exit the position, move your money into a similar stock at the same price level or close to the price level. I'd rather see you chase back, or if you want to chase losses, at least chase your losses with a stock that's looking good instead of one that's moving lower. you know, I was talking to Joe today, and we were talking about using the watch list. Let me just show you. This is the TD Ameritrade platform. This is the Thinkorswim platform. This list up here on the left, hopefully you could all see this. This is my watch list. This is the one that I've built in stocks that I watch. I constantly am monitoring all these stocks for the next trade candidates, okay? However, if you look down here, this is the top 10, what they list as the sizzling stock list. This is what the platform offers me as a list of possible candidates that are hot right now. So what I do is each and every day I scan this list. Let's go to this one. See, now this could very much apply to what I'm telling Mike. All right, you're in a $5 stock, but here's a fairly cheap stock. I have no opinion on this. I just pulled it up randomly on the watch list here, and it looks to me like this has a long shadow with the bullish engulfing pattern on higher volume. So that looks like a pretty good candidate. And if I was forecasting this, I'd say this stock has a shot to go higher. That looks pretty strong, actually. So what I'm saying is get out of the weak stocks. Don't let them create too much pain. Get rid of the thorn that's in your side. Look for a healthier stock. And then what you're really doing is just changing the stock symbol of the position you're holding. You're still in the market. And instead of holding on to the one that's been hurting you, you're holding on to one that could actually help you out of that hole. All right, so hopefully that helped you, Mike. Okay, UAL, this is coming from Nathan. UAL, I think that's United Airlines, right? Oh, yeah, okay. United Continental. The question is, watching for a green candle to possibly do an August 70-65 vertical put spread. So that would be a bullish put spread. I like your idea. I like it a lot, actually. But I would go a little bit further out if you could, because the 70 puts are almost in the money. And August might be a little bit too close, Nathan. You might want to try to look at September to get a little bit more meat. Let's even see if it's worth it on the 70 puts. Again, if you're an equity trader, you want to learn more about options, you might want to consider subscribing to the Option Oracle. I give good lessons, and I give video reports on that as well. So let's take a look at the September 70 puts. And Nathan, that looks like a very, very healthy premium. In fact, what I would do is I would probably sell the September 67.5 puts, give you a little bit more cushion to the downside. Maybe sell the 67.5s and buy the 62.5s, and you could still do that for about $1. That's a better one, and that's going to give you a 20% return. That'll give you a 20%. Is that a 20% return? No, that's a 5% return. Excuse me. Oh no, wait, that's a 20% return. If it stays over 67.5, you're making $1 on a $5 investment. Absolutely, that's a better choice, because you'd be short these, the 67.5s, and you're long the 62.5s, okay? And as long as it stays over 67.5, you get to keep the profit. So you have a long stretch of red candles, stale red light. You got a gap above the market. On the way down, the volume is dropping, and you're pretty much at a role reversal support level right there. Former resistance back here is turned into support. So I like that one as a better choice. You're going to have to hold on to it a little bit longer than you would in August, but I think that's your better choice with this one. And by the way, on the fundamental side, you know, the airline stocks are most likely going to show stronger profits next quarter, because the oil prices are still relatively low. And when oil and fuel costs are down for the airlines, especially, you know, like UAL, Delta, Southwest, LUV is another one. LUV you could look at. That's Southwest Airlines. These are all stocks that have taken a downturn, but look at LUV, one of the most profitable airline stocks, still in a nice upward trend because the fuel costs are down. And so that you got to consider that. And in fact, if you're in an airline stock like Nathan is thinking about right now, you absolutely want to track the oil markets, because the oil markets are going to lead the airline stocks, because if oil prices start to go up, there's a lag in the exchange and profits down the road. So that actually the oil markets are a leading indicator for the airline stocks. Keep that in mind, Nathan. Okay. Wow, 6 minutes to go, and I still have more than 6 stocks. Okay, Tom says, looking for an entry point in RIG. Talk about oil markets. RIG is one of those drillers. Why isn't that not coming up? Okay, RIG. This is an oil driller. This one is starting to look more promising. Although the candle is red, the stock is now starting to maintain levels over the 20-period moving average. Okay, so that is a very, very good indication that the trend is starting to reverse. Okay, so that is something I would definitely consider as a long position, Tom. But I would still wait for the green candle to show up, and you might actually see that tomorrow. If we get a lower volume day tomorrow and a green candle, that would be your sign. And the other thing is, here's a cheap stock, and I wouldn't, I wouldn't mind getting involved in this one, even though it's cheap, because this is still a widely held stock by institutional holders. The institutions love this one, and so there's a support level right above 7.5 that you can use as a get out point. So this is a really good candidate, Tom. I would just wait for that green candle, and you could, if you want to keep the stop a little bit tighter, you could put it below the 20-period moving average, or give it a little bit more room to breathe and put it below the support level here, down probably around 740. So you're going to be putting about $1 stop risk per share on that one. And again, make sure you're managing risk on that, because sometimes the cheap stocks could fool you. You think, oh, what can I lose? It's a cheap stock. Well, you can lose a good percentage if you buy too much of it. All right, Ken says, I want to buy GILD. That's Gilead Sciences. This is a pretty volatile stock. But Ken, immediately the first thing that hits me is this long stale green light. You see that? This is a very vertical move. I would not be buying on this just yet, because you have a vertical move as it's let me get rid of all these other lines, because we analyzed this one before. You could see that it is right at a resistance point, not far from it. So resistance is right there at 76. So you're only $1.64 away from hitting resistance. And you have an open gap below the market. You see that? So think about this. Vertical price move, rubber band is being stretched. That's negative. You have a gap below the market. That's negative. You have a stale green light. That's negative. And you have the stock approaching resistance. That's all negative. So what do? Well, put it on your watch list. Wait for a pullback. It could either be a bounce off of the 20-period moving average or a bounce off the gap fill point. And then after the stock is pulled back, corrected, then you can get involved in this area, but only after that gap is cleared out. Reason I'm paying so much attention to the gap is because if you look back at Gilead Sciences, it looks to me that 100% of the former gaps have filled. All of them have filled, except for the recent one here that's opened. So that might even lead me to believe there's a 90% chance that gap is going to fill. So keep it on your watch list. You don't throw it away and never look at it again. Keep it on your watch list. Put a price alert right there. Set a price alert for 67.60. When the price alert goes off, go to your charts, look at it. If all the signals look strong, you got bullish signals, then get in there. Okay, I have time for one more. Dave says, long SIEN, stale red light and hammer. Okay, so if you're long it, SIEN, oh, S, not D, SIEN. Whoa, that's pretty vertical. What is everyone seeing here on the volume? Look at that. This is very much a pendant, believe it or not, pendant or a wedge or a flag. You got the flagpole here. this is one of those price patterns where I don't see any gaps, but this one could actually be a very good buy candidate because of the pendant here. You see, when you see long flagpoles up and you see the wedge or the formation up here, this flag or pendant, when the stock breaks out of these highs, that becomes a fairly significant buy signal. So Dave, you got to watch that one. And if you own it, if you already own it, then you need to put a stop right below today's low, because if this thing does not break out and continue on with its upward trek, it could very easily start coming back down, and it could drop down to 980, which would be the next role reversal support here. So protect your profits. Congratulations on being long, and hopefully you're making some money on this one. But I would be very, very cautious on this one that it doesn't break down below that low. And there it is, 9 o'clock. Did not run out of stock symbols because you all kept me pretty busy, but we just ran out of time. Remember, be the ambassador for technical analysis. Be that ambassador. My goal is to continue to improve on the services. If you are a subscriber and you're not subscribed to the WhatsApp app, which is the application you load to your phone, then just load it to your phone. We have a new subscriber just loaded it, but he's got to get a new phone. I can stay in touch with you that way, and also not just through the WhatsApp app. If you go to the Market Guys Facebook page, you'll see that I often will put notes out on the Facebook page for the Market Guys. One of the most recent ones I put, if you don't know, Gary Cohen is now working for the Trump administration, and he's a director for economic, he's on the National Economic Council, and Gary and I actually traded on the trading floor. I stood side by side with Gary for almost 10 years, so I know Gary very well. I'm not going to tell you he's my best friend. Let me put it this way. I'm not too crazy that Donald Trump is thinking about making him Federal Reserve Chairman. I'm not crazy about that, because Gary is very much embedded in the Goldman Sachs, Goldman Sachs Wall Street Club, if you know what I mean. And I'm not crazy about Goldman Sachs. I think they are a very big part of the big picture with regard to manipulating global currencies and economies. Gary's a nice guy, but I would not like to see him as Federal Reserve Chairman, and there is some scuttlebutt around that Trump is looking at him to being the next Fed Chairman. So I'm going to be posting information like this that might be relevant to the markets. Go to the Facebook page, subscribe, it's free, or follow me, it's free. We have, how many people we have now? We have almost 5,500 people follow me on here. And on Twitter, I think I'm approaching 40,000 people that follow me there. I do put out some information on Twitter as well. So you can follow me on Twitter, Facebook, and on WhatsApp through that application. So thank you again. I went 2 minutes over. Hopefully it was worth it for you, and I'm looking forward to our next call next month. Have a good night, everybody. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.